the sort of companies we own are companies that have very strong pricing power. And so if we do get into a situation where inflation becomes endemic, as may well be the case, these companies will be able to pass on inflation to either to consumers or to their customers. Many of the companies that we own are actually companies that don't charge anything for their product. So things like social media companies, where essentially the people that pay them the money are B2B. It's companies buying advertising on their space, and that sort of cost can definitely be passed on. Some companies are ones that charge a very small amount relative to the transaction that they're offering. So an example of that would be something like CME, where if you're trading, let's say $1 million of futures, you're only being charged about $1 by them to do that. And so again, it's almost an invisible cost. And then a lot of other companies that we have are, essentially very difficult to really figure out, that even prices have gone up. So something like Accenture, which is doing a sort of a must-have project on taking a company to the cloud. If they are working on a project, it's very difficult to tell that perhaps the project is costing a little bit more this year than it might have done last year. So the sort of companies we own have very strong moats around their business. They're very well protected, as it were, in terms of their franchises, and so will do well in that kind of environment. The central banks are a little bit behind the curve in terms of choking off inflation. But then if you look at how inflation has come about, we've had a kind of pandemic-related hiatus in consumer spending over the last almost 2 years now. And that has led to pent-up savings and people wanting to, spend this money now that they can, now that they're out of lockdowns and having the ability to go out again. And that has been met with a restriction of supply. So the supply is somewhat restricted by the fact that a lot of things like restaurants might have shut down, or shops might have shut down because of the pandemic when they weren't able to do business. So there's less of those around. And then supply chains that largely come out of Asia have also been impacted by the fact that they've been in lockdowns as well. So we've got a bit of a supply shortage meeting a sort of a demand surge. So there's no question that at least some of the current inflation is temporary, and that will roll off once we get back to a more normalized situation. People get back to having normal spending patterns and supply chains and come back up, and then also we get things like new restaurants opening and what have you. So we will get back to a more normal situation, and central bank action at this stage, I think, has to clearly has to take that into effect, and I think they do. But beyond that, I think we're probably in a slightly more inflationary environment than we were going back the last few years. By which I mean probably something in the region of maybe 2 to 3% annual inflation. And clearly, where central banks are right now is not, wouldn't be coping with that kind of rate of inflation. So we will have to see an adjustment to interest rates, but we don't see them going up to anything like historically high levels. Historically, if you look at falling interest rates, has been good for the growth sector. And that's really because the discounting effect of money in the future is set by the level of interest rates, and growth companies tend to have more in the future. And so, they're more affected by lower rates. So lower rates, more increase in the value of these kind of growth companies. And equally, value companies tend to do better. So why is that? Well, if you're, what are value companies? It tends to be things like banks. So higher interest rates are good for banks because they can pass on a spread more easily, the difference between what they lend at and what they borrow at. So that's good for them. It's good for people like oil companies, miners, the sort of the value cohort. So yes, that's short term. That is what we're seeing, and I think that's already been reflected to a large extent in the market rotation that we've seen over the last 6 months plus. But if we go a little bit further forward and we say, right, well, what sort of companies actually do well in a slightly higher inflationary environment? It is companies that can pass on their costs and companies that can continue to grow. So if we think about the sort of companies that we own in our portfolio, they tend to be long-term, innovative companies that can compound their growth because they've got an open-ended growth opportunity and they are great businesses. And those sort of companies can pass on price, and they continue to compound their earnings and grow reliably annually each year. And so over the long haul, they tend to do extremely well. Whereas if you think about things like banks and oil companies, energy companies, mining, for instance, they tend to do quite well short term, but they can't deliver on the same sort of rates of growth longer term as the sort of companies that we would typically own. And so if you were to look at this, and we are long-term investors, so if you look at this sort of 5 years down the road plus, you would see that typically the sort of companies we own will have outperformed because they've been delivering on this kind of reliable growth. Whereas these other companies that I mentioned, the value cohort, require a lot of capital to go into their business for them to grow, whereas our sort of companies don't require that kind of capital infusion. And so it's very difficult for them to, for the value cohort to deliver anything like the sort of rates of growth that our companies do. And over time, that gets reflected in the stock market.